Okay, hi and welcome everybody. This is Lori Hensick, the the former Director of Educational Affairs. My newer title is the Director of Policy and Research for the American Military Partner Association. I just want to say thanks for joining us on today's webinar for discussing state taxes or filing your 2014 state taxes for our LGBT military families. Just to let you know that this current webinar will be recorded and it will later be posted online on our website, which is www.militarypartners.org. We also did a federal webinar last week on the 24th, and that too was recorded and will be posted online. Once both sessions are posted online, we'll send a blast out to our membership to let them know that they're available. So for any of your colleagues or counterparts that may be missing today's webinar because of the Super Bowl or perhaps missed last week's webinar, they will be available and we'll let you know as soon as they're posted online. Without further ado, I'm going to go ahead and introduce our presenter today. We're very, very lucky to have one of our own AMPA members, Karen Bolender, presenting the webinar for us. Karen is a CPA and she is a partner in her firm. She currently resides in Michigan with her spouse, who is retired U.S. Air Force service member, or veteran, I should say. So I'm going to let her take it away so that we can stay as best as possible within an hour time frame so you can enjoy the Super Bowl. One last thing before I turn it over to Karen is that this is a live session, so that means that any questions you have, you're able to post in the question box within the webinar. So as your questions do come in, or if something that I say or that Karen says generates a question, please do post your question within the question box or the chat box. I'll be monitoring the question box as the moderator, and I'll be interrupting Karen here and there with some of your questions. Now, if there are a lot of questions and I'm not able to get them answered sprinkled throughout her presentation, there will definitely be some time at the end of the presentation as well for some general Q&A. So fear not if your question does not get answered within the time of the actual presentation itself. We'll make sure that your question will be answered. And then the very last thing is our email addresses are posted on the slides. If there are questions that come up even after the webinar, or if your counterparts are watching and they have questions since they're not in the live sessions, you should know that you should feel free to email us at any point in time throughout the tax season as you're preparing your files, so that if questions do come up later that you hadn't thought about today, that you can reach out to us. I will tell you that since Karen is a CPA and a partner in her firm, she tends to get very busy close to the April 15th filing deadline. So definitely the earlier you ask questions via email, the greater the chance that your answer will be returned in a timely fashion and comprehensive. So without further ado, thank you all for joining, and I'm going to turn it over to you, Karen.
Thank you very much, Lori. Good afternoon. It is afternoon on both coasts. Again, thank you for joining us on Super Bowl Sunday to talk about taxes, of all things. So this is part two. Last week we did the federal taxes. What I plan on doing today is to go over real quick the federal taxes, because a lot of the states will base the state tax return off of your federal tax return. So you want to make sure that whatever you do federally, you comply with the state laws as well as far as filing goes. So it all starts at the federal. So we'll get started here. This is informational only. I'm not giving any kind of legal or tax advice. This disclaimer of the day. So, are we really married? Am I really married a year later? I was sharing with Lori earlier that when I got to do the slideshow this year, instead of there being 10 to 15 states that would accept a federal or the married filing joint tax return, there's now 31 states plus the District of Columbia that will accept a joint tax return, so on the state level, which is really cool. So basically the federal recognition of same-sex marriage applies to the state as well. So if you were married in a state or a foreign country where it's legal, you can reside anywhere, whether it's recognized or not, and still be considered married for filing. So that's the thing that you're going to base your federal tax return on. And 2013 was the first year that there was a requirement for you to file a joint tax return if you were married for federal purposes. So if you filed 2 single taxpayer returns in 2013, you're required to amend those. Prior to 2013, you can amend those tax returns back to 2011. So 2011 and 2012 are open for amendment as well. It's real quick, registered domestic partnerships, civil unions are not recognized as marriage for the filing tax return for federal. So I quickly went over this I'll quickly go over this. I went over it in detail in the federal, but should you file jointly or separately once you establish that you're married? There's both advantages and disadvantages. I'm going to run through some scenarios in a little bit that shows what the differences are. So filing your joint tax return, you want to make sure that if you're establishing who the taxpayer is and who the spouse is on the initial tax return, that you adhere to that order from that point forward. The IRS doesn't like you to change that in any way. They like to see the same person as the taxpayer year after year. So it doesn't matter which one is taxpayer and which one is spouse. You just need to be consistent going forward once you establish it. So if you're filing separately, both spouses' names still need to be part of the tax return. You'll notice that there's a taxpayer with a Social Security number. There's not a spouse name, but there is a spouse's Social Security number. Down below, you can see that there's a spouse's name on the married filing separately line. Schedule A, this is used when you commonly own a home, or if you have a high state income tax being withheld on your W-2. One of the states that has maybe a higher income tax withholding rate is California. So if you're a resident of California and you're having taxes withheld, you may be eligible to itemize your deductions and get an amount higher than the standard deduction. So the deductions include income tax withheld, the real estate and property taxes that are related to automobiles, motorcycles, boats, motor homes, home mortgage interest and insurance premiums, charitable contributions, other items that may or may not pertain, casualty loss, theft loss, and unreimbursed employee expenses, and tax return preparation fees. Note, if you're married filing separately and one spouse itemizes, the other spouse must itemize, even if it's less than the standard deduction. So here is the Schedule A, and you'll notice that line 5 is the state and local income taxes. That's where if your withholding is greater than the standard deduction, you can benefit from getting the itemized deductions, especially if you have given charitable contributions. They now become eligible for reducing your income in your tax return, even if you don't own a house. Medical expenses, this year it jumped, well, this year it was actually 2013. They changed it from 7.5% to 10% of your AGI. A lot of folks don't reach that level, so it's not available to them. The other itemized miscellaneous deductions that's common is if you have gambling winnings from a casino and you're able to itemize your deductions, you can actually take losses against those winnings to reduce the taxable income. So here's where, quick scenario, do I file separately? you don't have to live together in order to file a joint tax return. So if you're separated by deployment or living in separate states for any reason, as long as you desire to file a joint tax return, you are able to do so. Will you itemize or not? That question, comes to mind because if one spouse itemizes, the other spouse has to itemize as well. So do you have enough itemized deductions to take care of both of your tax returns in reducing your taxable income? Does one spouse make significantly more? I'll show you a scenario in just a minute about that. And then which tax bracket are you in? And do you live in a community property? I believe it's going to be in the future slides, but there's a number of states that are community property states. And because they require you to report 50% of each other's income, does it really benefit you from doing a separate tax return, because you're still going to be reporting the same amount of income on the two tax returns with the deductions. So the other note to make is that if you have children and you've physically lived with your spouse for more than 6 months, you cannot file the head of household. The head of household is available if you have children and are a single parent. You can file a head of household, and it gives you some tax breaks on the standard deduction as well as the tax brackets. So here's scenarios real quick. This is both of the spouses make approximately the same income and they take the standard deduction. The tax savings is minimal. One spouse makes more than the other taking the standard deduction. You can see here where the tax liability between the two separate returns is $15,493. But if it's a joint tax return was filed, the savings the tax would only be $11,864, giving you a savings of $3,629. The reason being is that the joint tax return allows you a larger amount of income in each of the tax brackets, so you don't jump into a higher tax bracket at a lower income. So the last one that I'll show you is with one spouse making more than the other, utilizing your itemized deductions. And you'll notice that even in this case, there's just under $2,100 worth of tax savings by filing the joint tax return. Note here on the itemized deductions, the split's different. It's not 50-50, based on the fact that the higher wage earner will have higher taxes withheld. So just because you file a joint tax return doesn't mean that you have to split maybe the house deductions 50-50 either, because you can also base that off of the income ratio. So if you have an income ratio that's 60-40, you can split the itemized deductions related to the ownership of the house at the 60-40. So these states do not have income tax, therefore there is no state filing requirement. So Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. However, the states that have the asterisks are community property states. So Nevada, Texas, and Washington. So for those states, if you were to file a married filing separate tax return, you would have to pick up 50% of the income of your spouse, and you would also allocate 50% of your income to your spouse.
Karen, this is Lori. I have a question.
Yes.
So going back to the last slide where you had the table and you were talking about those individuals who, might have two different incomes, and say you were talking about like house taxes or property taxes, for example, and that you could split it so that the percentage of the deduction was commensurate with the percentage that each individual is contributing to the income. Is that correct?
Correct. Yes.
So here's the thing. What about, is that the case in community property states? So for example, in somebody who is in a state like California or one of the other community property states, can they still split, can the spouses split it with different percentages, or do they have to split it in a community property state 50%, 50%, or are you still able to choose who gets to deduct what percentage?
So the interesting thing about the community state is that it's about ownership, and it's about the earnings within the marriage. But I'll have to confirm this, but I believe because the deductions are a federal what's the word I'm looking for? It's a federal regulation. If you can show based on real income that one person is contributing more than the other, then you can take the deduction. And what the IRS looks at, I believe they call it, it's like economic risk or economic harm, whereas if you are providing a higher percentage of the funds to make the payment for that deduction, then you basically are economically out of pocket more money, even if the state community property rules state that what you earn is 50% allocable to your spouse and you get 50% of their income. The ratio is still going to be in place.
And the couple gets to determine the ratio, or does it have to be equal to the ratio of the wages?
No, it can be based on an agreement. And I know in the past, before joint federal tax returns were available for married couples, I would do their tax returns, their two individual tax returns, based on the income ratio. If they had a joint checking account that both of their wages went into and then the payments were made out of it, I would look at the ratio of their earnings and then prepare the tax return such that this person maybe got 60 and the other one got 40.
Got it. Thank you.
And that was in Arizona, which is a community property state. So, but I can definitely look into that and verify that in a community property state that deductions can be allocated based on an income ratio of actual versus allocations of 50-50. Okay. Any other questions on that?
No, I think you can go ahead.
All right, we'll go ahead and go back to the states with no income tax. I believe we were done with this. So now comes the marriage equality states. And the good news is that there's a larger list this year. You'll notice all of these states will allow you to file a married filing jointly tax return or separate, depending on what the rules and regulations on in the state, because some states require that you file exactly the same way that you filed on your federal tax return. Other states will allow you to file a married filing separate tax return, even if you filed a married filing joint tax return. So one state that has not officially recognized same-sex couples, but will allow them to file joint tax returns is Missouri, and that was actually available in 2013 as well. So now we get to the non-marriage equality states. Much shorter list this year than it was last year. Real quick, I'll run through. There's a number of states that base the state tax returns off of the federal adjusted gross income, which means that if you have a joint tax return, the federal adjusted gross income includes both spouses. But for the state, you have to file a single tax return. So federal adjusted gross income doesn't equate to what you are going to put on your state tax return. So there's a number of ways that they ask that you reconcile your federal income to your single income. It looks like Arkansas and Tennessee are two states that basically work off of your individual income tax from the state from your gross wages down. They don't pick up your state income starting with the federal adjusted gross income. So for those two states, you would basically have to prepare your married filing joint federal tax return and then two individual tax returns, one for each taxpayer. And for the state of Alabama, which is a unique situation, they actually require that your state tax return is apportioned based on the ratio of the total federal AGI. So there's actually a bulletin on their website if you need to file there, where it runs through how to do this apportionment based on the ratio of the federal AGI if there's adjustments on the tax return. So for, let's see, Georgia, Kentucky, and Nebraska, and Michigan, you actually will have to file or prepare a sample federal income tax return as a single taxpayer. So for those states, they want to see what your federal tax return would be as if you were filing as a single person. So in that instance, you would actually prepare your joint federal tax return, two single federal tax returns, and then your two Michigan tax returns. And the reason why I say Michigan is because that's where I live, and this is what I have to do for my own personal tax returns with my wife. With my wife, we actually have to file. Basically, I prepare 5 tax returns in order to file our taxes each year. So,
and just a comment, sorry to interrupt, just a comment on that for our audience, and that's why sometimes if you were to go to a tax preparer, your preparer's fees may differ widely across different states because tax preparation in states like Kentucky, Nebraska, Louisiana, Georgia, and Michigan, you can understand why maybe a tax preparer would charge higher fees because that tax preparer is then required to essentially do 5 different tax returns versus somebody in one of the other states that has different requirements. So keep that in mind as you're going to, if you're going to use someone to prepare your taxes, that depending on where you are and the layers of bureaucracy that you might have to do or deal with, that that will probably translate into different costs for tax preparation costs.
Thanks, Lori. Yes, that is true. Unfortunately, because of the way that the states are handling the recognition of same-sex marriages, those particular states, those 5 states, do create a larger scope of work that a tax return preparer will need to do in order to comply with the federal filing requirements as well as the state filing requirements. So lastly, the last states, Kansas, North Dakota, and Ohio, actually have a separate schedule that shows the allocation of the federal tax return to each of the individual taxpayers. And so it's a 3-column form that you complete. Here's the federal tax return, and I'll use the slide examples. There was the 2 spouses, one made $75,000 and one made $25,000. So on that form, the federal income would be $100,000, the taxpayer would be $75,000, and the spouse would be $25,000. And that's a form that follows each line of the federal tax return has the allocation of what was the taxpayers and what was the spouses, and that has to be filed with the state tax return in order to have a complete filing for that particular state. And real quick, what happens with a state that starts with a federal adjusted gross income? They have a matching program where they go out to the IRS. When they receive your tax return, they go to the IRS and they request the information from your tax filing under the federal tax return for your Social Security number. So if you're the taxpayer on a federal tax return that's joint and they ask for your federal adjusted gross income, it's going to show the total of the $100,000, whereas only $75,000 is attributable to you. So that's why they're creating this, whether it's a form or it's another federal income tax return that you have to send in as if you were a single person. That's the reason why. It's because of the way that they receive the information from the federal government. They need to be able to reconcile it so that they can confirm that your tax return has been prepared in compliance with their reporting requirements, and then they'll issue, if you're due a refund, then they'll issue the refund. So if you're filing your taxes and you don't have one of these schedules, or you don't have the sample federal income tax return as the single payer, your refund will be delayed because more than likely they'll send you a notice and say, hey, your federal adjusted gross income per the IRS is $100,000, but you're telling us, your adjusted gross income should only be $75,000. We need more information. Or they assess, tax due, or they deny your refund and saying, hey, you're not going to get back the original refund amount. We've reduced it by the additional tax on your additional income. So that's why the schedules are important to complete, so that you don't create a situation where you get assessed further tax or your refund is delayed. So as I stated earlier, for the community property states, they have the unique rules for reporting to married filing separate tax return. So there's a publication out on the IRS website that basically gives the rules, but it states that each spouse reports 50% of the other's wages on their state tax return. And the interesting situation that the federal government actually created was California was allowing couples that were married and or in a registered domestic partnership, they were required to file a state tax return, but they weren't recognized for federal tax purposes. But the federal government came in and said, oh, you live in a community property state, you're filing a joint tax return, you now have to file 50% of each other's income on your federal tax return. So here's the list of the community property states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So hopefully everyone is familiar with this, where there's special rules based on your home of record or home of domicile for your military pay. It all depends on, where your home of record is, as well as the state that you're currently posted in or residing in, and how they handle those, the military pay. So this is a website that goes through and basically gives a great overview of, if you're a Michigan resident and you're stationed in Arizona, do you have to pay taxes, to Arizona? Do you have to pay taxes to Michigan? And I can tell you that the answer is no on both, because home of record is Michigan, posted in Arizona. Arizona doesn't recognize you as a resident of Arizona, and Michigan doesn't tax military pay. So if you have any questions about whether or not your military pay is taxable in the state where you're at, this is a good resource.
Karen, I have a question, because this is a very, very common question or scenario for our members. So I just want to make sure that we reiterate this point, because a lot of our members make sure to keep their home of record with a certain specific state, because they know that that state doesn't have state tax. So, for example, Texas or Illinois, right? So those service members are obviously, probably not going to be residing in that state every single year. So their question is, and this is a very common question we get every year, so if your home of record, if they know already that their home of record is a state that is not does not have a state tax, regardless of where they live, does that mean, so for example, if somebody is with a home of record in Illinois that doesn't have a state tax, but is, stationed in California or some other state that does have a state tax, do they have to file state taxes in the state where they are currently?
And that depends. I just had this come up for a tax return that I was doing. If the W-2 is issued with state wages on the W-2 for that state, even if there's no tax withheld on it because it's not taxable in that state because you're in the military, there may be a requirement to file a tax return as a non-resident to show the wages, and then show the subtraction for it being military pay, and have it be zero. So at the end of the day, the tax return is a zero tax return. But
right, because I have heard. Sorry, go ahead.
I was going to say, but because of the W-2 matching, where the state gets the W-2 and they're like, oh, so and so has wages of $12,222, but we never got a tax return from them. I'm trying to, and I apologize, I'm trying to think back a number of years when Deb was still in the Air Force, how her W-2 came as far as the state that was on her W-2, and I believe it was Michigan.
So what you're saying is that it depends if the W-2, if the service member's W-2 comes to them but has the state where they reside listed instead of the state where their home of record is,
Right.
assuming their home of record is a non-tax state, that they
Right.
would then still have to file with the state where they reside because it's listed on their W-2, but they would file just for the purposes of kind of proving that, yes, I have a, a W-2 with your state listed, however, I'm military, so it ends up being zero. So it's not that they're going to get taxed, it's just kind of proving that their home of record is a non-tax state. Is that what I'm understanding?
Right, and what happens is it's a non-resident state or tax return. So because even if you physically live there 365 days, because your home of record is in another state, you're still considered a non-resident for that state. So real quick, scenario is you're stationed in Georgia, but your home of record is Texas. Texas doesn't have income tax. You were in Georgia a full year. You were there for 365 days. You get your W-2, and it shows, Georgia with your wages, and there's no income tax withheld on it, because there should not be. You would file a Georgia non-resident tax return showing the income, and either through this is military pay, I get to subtract it from my income, or the income is deemed to have been earned in my state of residence, which is Texas, so it's a subtraction from the Georgia tax return. Your taxable income is zero. So you would file the tax return in that manner, and you would meet your filing requirement because you got a W-2 with the state income on it, but have zero tax return, taxable income, and there's no filing requirement in Texas, and so you're done.
Perfect. Thank you.
Okay, and that segues right into my next slide, which is there's a relief act. It's called the IRS Military Spouse Residence Relief Act. And basically it says if your home of record is not the state of residence when you're in the military, meaning that you've retained your home of record going into the military rather than changing your residence with each change in post. And you're married, moving from state, from that state of record or your previous post or whatever, you go into a new state, as long as you're married prior to going into that state of residence, you can file for an exemption from having to pay state tax for the state that you're living in. And there's a form that you need to fill out through your human resource department that they'll then file with the state. And basically what you do is you pay the taxes in your home of residence or your home of record. So real quick, I'll go through a scenario where, again, I'm going to use your home of record is Texas, your spouse, you're married, you move from Texas to California. So now you're living in California, which has a state income tax, and it's at a higher rate than zero. You, as the military spouse, can go to your HR department and say, I'm a military spouse, our home of record is Texas, I would like to be exempt from paying California state tax returns. And they'll fill out the form, and basically what it eliminates your requirement to file a California tax return. Basically what this Resident Relief Act was for was, with each move, the spouse became a resident of the state that they were moving to. And so every year or I shouldn't say every year, but every time there was a change in station, you would have your federal tax return, you would have your home of record return, and you would have the new state that you're living in return for the spouse if they were working outside of the house. So in order to, I guess, ease some of the burden that comes along with moving as often as military families can, they came up with this act that basically says, yes, we know we're going to move you around a lot, but you can maintain your home of record and not have to then pay taxes in each new state and file a new tax return every time you move. So if anybody believes that they're eligible for this, all they need to do is go to the Human Resource Department and let them know that, hey, you know, I'm a military spouse. Am I eligible for this relief? And fill out the paperwork and see if you are.
And Karen, I have a comment on this. Since this is a state-based act, that would then mean that, does that then mean if they are moved to a non-equality state that this is not available to that individual?
I believe that is the case. I'm trying to remember from when I looked it up. So I believe that it's based on the state. So if it's a non-equality state, it's not available. But for, you know, the numbers dwindled this year, which is, you know, the good news.
Right. So just to make sure our listeners understand that this is really helpful relief act that can save you a considerable amount of money in terms of taxation. Unfortunately, if your move is from one state to a state that is a non-equality state, that you then you are rendered ineligible because obviously you're applying for this exemption within a state that doesn't even recognize your marriage to begin with. So
correct.
While we would never discourage somebody from applying or disclosing their marriage to their HR department if they feel that it would not be unfavorable for them to do so with their current employment, we would never discourage you from trying, because what we have found with some of our veterans is that sometimes even things when you're quote unquote not allowed to do is there might be some that slip through the cracks or whatnot and what have you. If you do happen to file for this exemption in a non-equality state and you are granted it, or vice versa, if you are denied it, that's something that definitely you want to make sure that you reach out to your leadership within, you know, so one of us, one of the AMPA leadership members, so that we can kind of take that and track it and move it forward. And those are very useful pieces of information for us for our advocacy. But I just really want to make it clear that while this Residence Relief Act sounds very good, and it is, because it can save you money, specifically, like for example in the example Karen mentioned, if you move from somewhere that has no state tax to somewhere like California, which taxes you at quite a high rate, you would be saving a lot of money. Luckily, California is a marriage equality state, so you would be eligible, but there might be a state where you are trying to file for this exemption, and if it's a non-equality state, you may not be successful, and in fact, you know, the expectation is that you wouldn't. So if you do experience any of that, please be sure to reach out to us and let us know so that we can use that as part of our advocacy.
And I agree, Lori, with what you just said, because what you may find is, depending on what the disclosure requirements are for the state, if the company that you're working for recognizes that you're married, even if you're in a non-equality state, they may be able to process the paperwork requesting the eligibility, or, you know, requesting the exemption from the taxes.
But we also want to be very careful because there are still a significant number of states where someone can be fired
Right.
for being LGBT or T. So that's why we say, you know, of course, use extreme caution if it's, and only talk to your HR department if it's safe for your employment to do so, because we would never want you to try to save a little bit of money on your taxes at the expense of, you know, suddenly becoming unemployed because you disclosed your sexual orientation or your gender identity.
Right, and you know, I mean, I happen to live in one of those states. Thank God I'm a partner in my firm, so you know, fear of being fired is not there. But you know, I certainly am very cautious in communicating with my clients what my situation is, because it's not something that I trust that if I tell them that it would sever the business relationship. You know, just because it is the state of Michigan and there is a ban. So you know, I totally get that. Yeah. So yeah, I would also reiterate what you were saying, in that under, you know, only certain circumstances would I recommend going in a non-equality state, or even in, you know, to do this. But it is available, you know, in those equality states. But it's also important to note too that in equality states, you can also be fired. So, you know, even if it's available because you're in an equality state, what are the laws governing the firing of you based on I guess the fact that you're in a same-sex marriage, because I know that Arizona is an equality state, but you can be fired.
Right. So I'm just going to clarify is that it's really mutually exclusive from whether or not you're in an equality state. What I want our listeners to understand is, if before you discuss with your Human Resources Department if you are eligible for the Military Spouse Resident Relief Act, regardless if you're in a equality state or not, you will want to make sure that you know if your state is one of those states whereby you can get fired for being LGBT or T before you do this, because the incremental savings on your taxes may or may not be worth the risk of losing your job. And that's regardless if you are in an equality state or not. So really it's no bearing of that. It's just make sure that you understand your state laws. And then the next layer of that is, obviously, if you're in a non-equality state, they would likely to not grant you this exemption because they don't recognize your marriage. So I just wanted to say that before moving on to the next slide.
Yes, thank you. I think so. Given the complex environment of doing taxes, if you're in a non-equality state, especially, you know, the question comes up: should I prepare my own tax return? So there's a list of questions that I've created. This is also in the federal. So, you know, which forms are you using? How many states am I going to be required to file? Is it going to be multi-state, multiple within a state? And that's where you're in a non-equality state. Have you prepared your tax returns in the past? Have there been any major changes in your tax life? Purchase of a home, birth or adoption of a child? This one I always point out, you know, not that anybody wants to be picked for an audit, but do you want representation if you know, if your return is picked for an audit? And I shared with everyone last weekend that my philosophy is that I've prepared your tax return. If you get a notice that, you know, the IRS wants additional information or they're auditing your tax return, I communicate with the IRS on your behalf. I get a power of attorney that basically says I'm your advocate. the individual taxpayer is not required to talk to the IRS at that particular point in time, so they don't have to worry about talking to the auditor. They don't have to worry about doing any kind of transfer of information to the IRS. I take care of that. As a rule, all of the CPAs that I've ever worked with, they work along the same premise. We prepared the tax return. We know, the tax laws. It's been my experience of running into a couple of auditors that there's an intimidation factor that they want to use on the taxpayer that they can't use on a CPA. And so the question is, do you want representation if you happen to be picked for an audit? If you prepare your own tax return and you get an audit letter or some sort of notice from the IRS, at that point you can go to outside help, CPA firm or an enrolled agent who's able to represent you as well in front of the IRS, and ask that they represent you. And from that point forward, they'll do the same thing. They'll just have to ask more questions about, how did you prepare your own tax return. But that is available as a service from a CPA or an enrolled agent. So the IRS provides some really good guidelines for finding a preparer as far as, what are you looking for. So here's some tips. The IRS is already accepting tax returns. If you're able to use utilize the free filings through the IRS for at least your federal tax return, I recommend that you do that. And if you're not comfortable with preparing your own return, you can find a preparer with, you would like to find a preparer with knowledge of your issues, which have a lot to do with the LGBT as well as military. You can educate yourself about the different preparers, and this is where the IRS lists CPA, attorneys, and enrolled agents basically as the three that they recommend, as well as those are the only three individual preparers that are eligible to go before the IRS on behalf of their clients. So you can look in the local business directory. A lot of times if there's a Chamber of Commerce that's an LGBT Chamber of Commerce, they might have a business directory that you can look at. Ask your friends, someone that uses an outside preparer to do their taxes. And then also you can call, the LGBT Community Center. And then we hope that this never happens, but if you believe that you were given incorrect or fraudulent advice on a tax return, you can actually report that to the IRS. There's a form that you can go to and make a complaint. So questions about state tax return filings?
So surprisingly, we don't have any further questions. At least, one just popped up, so let me see. Okay, so I'm not sure if this question is complete. Oh, here we go. They're coming in. It's coming in pieces. So this couple are both from Miami, Florida, but they got married in Alaska, which is where the service member is stationed, and it sounds like where they're both currently residing. And so that's where, and then they're asking, where would we be filing our taxes? So again, okay. Let's clarify. So Charles, the person who's asking this question, we need to know, okay, there we go. We need to know where each of the individuals are living. So here we go, a little bit more clarity.
Okay.
So let me repeat. We've got a married couple who are both from Miami. Okay, so they got married in Alaska.
Okay.
The service member is currently stationed in Alaska and living in Alaska.
Okay.
But the spouse is living still in Miami, Florida. So they are asking where they would be filing their taxes, and I'm assuming they mean, obviously, their state taxes. They were married in November 2014, which, of course, regardless of what day they were married in 2014, the state thinks that they are basically married the entire year, so that doesn't matter when in the year they were married. But it sounds like he's wondering where they need to file their taxes. So really quickly, Charles, did you work anywhere else outside of Florida State? Did you receive any money outside of Florida State? Okay, and his answer is no, so he's only received money from Florida. And was your husband in Alaska for the entirety of 2014? Yes. And
what's his home of record?
Yeah, and where is the service member's home of record, if you know? Miami, it sounds like, so Florida.
So Florida doesn't have state tax return. It
Correct.
doesn't have income state tax. So there's no filing beyond the federal. And the federal would be a married and joint tax return. Even though they weren't living in the same state, they can still file a married filing joint tax return for federal purposes.
Right. So you got that, Charles? It sounds like obviously you're federal. Yeah. Okay, good. He's got it. He's great. Are there any other questions from any of the attendees before we close out the webinar? Just want to make sure. And feel free to even just write like a, hey, this is what we're planning on doing. Does that sound right? Even if you just want like a thumbs up or a clarification on what your plans are.
Questions about federal. You know, I mean, we touched on it just a minute just now, but is there anything on?
So this is a very common question. One just popped up. We get this multiple times every year. Is would it be better to file separate or to jointly? And Charles, don't worry, you're not alone. Every year we have people doing taxes for their first year together because every year more and more people get married, which is lovely. So you're not alone. So, but it's a very common question about whether or not it's better, meaning assuming financially beneficial, to file as separate versus jointly. And I'll let Karen give you like the generic overall kind of viewpoint on this, but do know that it's there's various individual factors that go into play in terms of what is more financially beneficial for each couple, because it's based on many different tiny specific details. But in general, Karen can give you an idea about what might be the best way to go for your situation.
So in general, when you think of taxes, they have tax brackets, and the tax bracket is based on your adjusted gross income. So in the earlier scenarios where I showed both spouses basically making the same amount of money, using the standard deduction, it was a low amount. I think I had it like at 25,000 or something, if memory serves me, and the tax savings was minimal. But when we changed the income, you know, to where it wasn't an even amount, it changed the taxability of it. So the overall answer to whether or not you should file joint or separate has to do with, you know, why do you want to file separately? Is there something outside of tax that's precipitating this desire? As well as where are you personally as far as your income and what tax bracket you fall into? So what I can give you just as a quick guideline, the 15% tax bracket, which is the lowest tax bracket, married filing joint. The beginning of the tax bracket starts at $18,450. Married filing separate, the beginning amount for this tax bracket is $9,225. So it's about half. It is half. The upper level is $74,900 for married filing joint, but it's only $37,450 for filing separate. So it's again half. If you get into the 28% tax bracket, which is the next one up, you know, it continues on this path of you get exactly 50% of the income at each of the tax bracket. That's why earlier when I showed the scenario, each of you making the same amount of money, the tax savings wasn't there. But if one of you falls in under, say, the married filing separate starts at or ends at $37,450, so, or it begins there or whatever. So if one of you has taxable income of $40,000 and the other one has taxable income of only $20,000, that's a total of $60,000. You're going to be in two different tax brackets individually as opposed to the same one. So I guess in short, where are you going to end up in the tax bracket, and does it benefit you tax-wise to do it, or if there's an outside reason for it, are you okay with paying more tax in order to take care of an outside concern?
So in general, the overall consensus for our listeners is that there could be a financial benefit for filing jointly if one of the spouses makes, I don't want to say significantly more, but makes more money, you know, a substantially more money than the other spouse. If that's the case, then there's generally a benefit to filing jointly instead of separately, because it kind of averages out between the tax brackets, if you will. That's kind of a very generic, not official way of explaining it. But just to give you a basic idea that if you have a big difference between the two incomes, between the two spouses, you usually see a greater financial benefit for filing jointly. And so that's what most people will do instead of filing separately. However, if your incomes are about the same, it really doesn't, that quote-unquote benefit is not really there. It's not necessarily a loss. It's just that you don't have as great of a financial benefit as filing jointly. So at that point, there's kind of it's kind of a wash. Either way wouldn't make as much of a difference. But for most of our members, especially in the military, because a lot of times since continuous employment is such a difficulty for a lot of our military spouses, oftentimes our spouses are either stay at home or they work part-time, or maybe they have significant periods of unemployment throughout the year. So if that's the case and you're making substantially less than the service member, then it might be to your benefit to file jointly instead of separately. So hopefully that helps.
Are there any other questions?
No, it doesn't look like. So no, but thank you so much for staying with us for the full hour. And do know that if there are any further questions, and like I said, if you know anybody who's going to be watching this webinar, or even you yourself are going to watch it, maybe you're not even, maybe taxes are just so far out of your mind right now that you're not even going to start on them for like another month. And then you rewatch this webinar and you have some more questions that come up, please do know that our emails are, again, we're on the first slide. They'll be available. You can search for my email. This is Lori speaking on the AMPA website. I'm one of the leadership members. You can email any of the leadership members any of your tax questions if you forget my name, and then they'll shuttle those tax questions to both me and Karen. And we're happy to help you throughout this tax season prepare so that you're doing things in the way that's going to benefit you financially the best, and then also just to make sure that you're doing things appropriate, so hoping that it will minimize any delay and any returns that you get, especially those of you who are living in non-equality states or states that require multiple tax filings for your state. But without that, I just really want to take a chance to give big thanks and a round of a virtual applause to Karen. She is a member of our AMPA community, and she graciously does this on a volunteer basis. So she makes herself available to all of us for the next few months with our questions, and really we wouldn't be able to do this without her. So thank you so much, Karen, for your time.
Oh, well, thank you.
Yeah, and like I said, as soon as these recordings are posted online, we'll make sure to blast it out to our community, and so that they can view them at a later time. Otherwise, thanks again, and enjoy the rest of your weekend. And until the next webinar, take it easy.
Thanks.